Good afternoon, everyone. So today we're going to discuss deductions from gross income. In this video, we're going to learn regarding the optional standard deduction. What are the things to remember in availing the OSD, and what are the rules and things we need to remember when we're going to use or avail the itemized deduction as deduction from gross income subject to income tax. So let's start. Deductions as defined by the tax code. Deduction is an amount that can be subtracted from a taxpayer's gross business or professional income. Take note, only gross business or professional income. So, it is not applicable for compensation income. So, deduction is the amount allowed by the tax laws to deduct from the gross business or professional income in order to reduce the amount of income that is subject to income tax. Okay, so there are two types of deduction allowed by our law. First is the optional standard deduction, or termed as OSD. It is a deduction from gross income allowed to be taken in lieu of itemized deduction for expenses and losses. Take note for the word in lieu. Okay, so if the selection or the option is not directly or specifically selected, so the itemized deduction will be assumed to be taken or to be opted by the taxpayer. The other one is what we call itemized deduction. So these are expenses and losses related to the business of the taxpayer. So in our accounting, uh, the term operating expenses is tantamount to itemized deduction, except that itemized deduction is subject to limitations provided by our tax laws. So OSD. OSD for individual, except for non-resident alien, it is 40% of gross sale or gross receipts. Take note, OSD is equivalent to 40% of gross sale or gross receipts, depending on the nature of the business of that particular individual or of our taxpayer. So if the business is a manufacturing or trading concern, so your 40%, the tax base of our 40% OSD, no, sorry, the base of our 40% OSD is gross sales. So if the business of the taxpayer is a service-oriented or service-related concern, the term that you're going to use is gross receipt. So the base that would be the base of the 40% in order to arrive at the optional standard deductions allowed for individual taxpayer. And for corporations, our OSD is still 40%, but take note, the base is gross income. So later, we will differentiate what is the difference between gross sale or gross receipts, which is the basis of our OSD for individual, as against to gross income as basis for the OSD for corporations. Okay, gross income. So for trading and manufacturing concerns, so as you can see, I have presented a sample income statement. So that is the typical format or pro forma of our income statement. Okay, so we have sales, then directly after sales, there is a cost of sales. So that's 2,700,000. Then the difference is what in accounting term as gross profit. And we have selling and operating expenses, general and operating expenses. So these are operating expenses. Okay? So, ang muning ginahambal or ang gina-considered as itemized deduction, ugaling lang, itemized deduction is subject to certain limitations provided by our law. Okay? So, for gross income, let's first review what is meant by law when we say gross income. Okay, so that would be the gross sales, then less sales returns and allowances. So now we can arrive at our net sales less the cost of sales if the business is a trading concern or cost of goods sold if the business is a manufacturing concern. Then now we can arrive at our gross income. So if you're going to compare that on the income statement provided, so we can consider or we can align that the gross profit plus other gross income from operation is equivalent to gross income, which is meant by the tax code, which is the basis in 40% for corporation. 40% OSD for corporation. Okay. So illustration, OSD between individual and corporation. Okay, so there are two sets of computation in order to appreciate or emphasize the difference between the OSD, the computation of OSD between individual taxpayers and corporate taxpayers. So first, we have your gross sales. So gross sales is equivalent to 3 million as given. So your OSD is equivalent to 3 million times 40%, and that is 1,200,000. How about for corporation? Assuming that they have the same information, gross sales 3 million. They have the same gross sales, the same amount, that's 3 million. But let's find out later if they have the same OSD. So take note, there should be a return and allowances. So for individual, take note the term is gross sales. Okay? So there's no more deduction. Once you have identified your gross sales, automatically multiply it by 40% and that is your OSD. For corporation, you have to exclude your returns and allowances. So given that's 20,000, then we can arrive at the net sales. That's 2,980,000. Take note, guys, that the base in computing OSD for corporation is gross income, not gross sales. Okay? So we have your net sales pa, 2,980,000, then less your cost of sale or cost of goods sold, whichever is applicable. So that's 980. Then we can identify your gross income, which is the base in computing the 40% OSD. So in our example, that's 2 million. So your OSD is 2 million times 40% is equals to 800,000. So take note, there is a difference. You have to identify first what is the taxpayer? Who is the taxpayer? Is it an individual or a corporation? Because the computation will vary. Because the tax base for individual is gross sales, while the base for OSD for corporate taxpayer is gross income. Okay, gross income is also called in accounting as gross profit if there's no other non-operating income. Okay, gross income for service concern. So, same is true with the previous example. I have presented a sample income statement for a service concern or service related business. So, as you can see, there is revenue, then the landscaping fees, financial charges directly related to landscaping fees. Then the amount is the total revenue. Then instead of cost of goods sold, the term is cost of sale, but it is termed in taxation as direct cost of services. Okay? Direct cost of services. Then after which there is a gross profit or gross income, whatever the term used, that's still correct, either gross profit or gross income. Then below it, there is an expenses or operating expenses. Then total operating expenses. Then we can arrive at your net income. So for taxation purposes, how to compute your OSD if the company is a service concern? So that would be your gross receipts less direct costs. So we are referring or we are computing the gross income, which is the basis in our 40% OSD. So less direct costs. Now we can arrive at your gross income. Okay, another illustration for OSD between individual and corporations. So individual taxpayers, the gross receipts is still 3 million. So the OSD for individual is 3 million times 40%. Then for the OSD will be 1,200,000. How about for corporate taxpayer? The gross receipts is the same. In this illustration is to compare the difference between the two taxpayers. Okay, so gross cost of services is 1 million. So now we can arrive at our gross income of 2 million. Take note, you have to deduct the cost of services, okay, before computing the 40% OSD. So your OSD will be 2 million times 40%. So your OSD is equivalent to 800,000. Okay. So direct. What are direct and indirect costs in service concerns? So direct costs. These are These are costs directly related to rendering of services. So it's like a cost of sale or cost of goods sold for a trading and manufacturing concern. But in this case, it is the direct costs related to the services provided by the company. Okay, so like for example, salary and wages of factory personnel, if uh, or shop personnel, if your company or if your business is a repair shop, so the salary of your mechanic, the salary of the attendant, the salary of all the people or the labor force employed in your shop is considered direct cost. So while the salary of your cashier, manager, any other office personnel or staff will no longer part or we will no longer considered as direct cost because it is part of your operating expenses already since it is not directly attributable to the product or to the services itself. Okay? So that's how to identify whether it is direct cost or indirect cost. So for number two, this is just an example. We have your materials, supplies, and facilities. Okay, so it is not confused that the material supplies which was used directly to provide the services offered by the company. Okay, so if the supplies is referred or used in your office or in the head office, so that would be classified as office supplies, and that is on the indirect cost of services. Third, your depreciation. So specifically, the depreciation meant is the depreciation on the machineries and equipment used directly to provide the service. So if the depreciation pertains to office equipment, computers, laptops, tables, furnitures which are used uh, in the administrative function of the business, so it will be classified as indirect cost. Okay? Fourth, rental of factory. So rents should be directly allocated or directly referred to the factory, not to the office. Okay? So if the rental is specifically for office rental, it should be classified as indirect cost. Then any other services, any other expenses that that can be directly traced to the services provided by the company, it should be classified as direct cost. While indirect costs, these are expenses in the operation of the business that is not directly related to the rendering of the services. So, examples, we have your bad debts, or these are accounts receivable declared to be uncollectible. So, it will be considered as an expense. So, obviously, that is a administrative expenses. Second, we have your bookkeeping expenses. So, mga professional fees related to the management and accounting is considered as indirect cost if your company is a service concern. Third, your office equipment, office supplies, then the depreciation of your office equipment was already discussed earlier. Fifth in Fifth is rental of office building. So guys, you have to check and you have to use your professional judgment in considering what are direct costs and what are indirect costs. Because every industries, every specific businesses has a different classification on how to consider it as either direct or indirect cost. Like for example, if your business is a if the taxpayer is practicing his profession, so the salaries of the professionals nga gin-hire sa company should be considered as direct cost. So, in my example earlier, it is a repair shop. So, the bookkeeping services was classified as indirect. So, that's one of the reason that you have to understand the nature of the business, then apply your professional judgment. The important thing is, you know that direct cost, it is a cost directly related to to the rendering of services, and for indirect, it is an expenses in the operation of the business that is not directly related to the rendering of the services. Okay, so important rules to remember in availing the optional standard deduction. One, if there is or are other items of gross income, it will be added to the gross income of the manufacturing, trading, service concern to arrive at a gross income on which the 40% is applied. So like for example, in the income statement presented earlier, okay, so there are gains, there are other income, you have to include this in the gross profit in order to arrive at the gross income which is subject to 40%. That's what is meant by number one nga things to remember when computing OSD. So you have to include all other incomes before. You have to include all other items of gross income. It will be added to the gross income of manufacturing, trading, and service concern in order to arrive at the gross income, which is subject to 40% OSD. Second, for individual who has both compensation income and business income, the OSD will be claimed only against the business income. Take note guys, OSD and itemized deductions are not allowed for as a deduction to your compensation income. Okay? Obviously, it is not allowed to be deducted from any compensation income, only for business or professional income lang. So it so happened that the taxpayer is a mixed income earner, so you have to separate the computation. Okay? So you have to separate the computation. So your OSD will be deducted only to your business or professional income. Third, an individual who is in business or practice or profession, the choice for the OSD is made in the first quarterly income tax return and must be consistently used in the other quarterly returns and in the annual income tax return. So the choice is irrevocable within 1 year. Okay? The choice is irrevocable within 1 year. Take note, if the choice was not uh, communicated, or if there's no return was filed for the first quarter, the taxpayer will be required to use the itemized deduction in all quarterly and annual tax return, because OSD is just in lieu for itemized deduction. So if things happen that the taxpayer supposed to be want to select OSD, but the circumstances does not permit him to do so, and he forgot to signify his selection, so the assumption is we will adopt itemized deduction. Okay, since OSD is just in lieu for itemized deduction, please take note. Okay, so let's discuss what is or what are itemized deductions. Okay, so these are expenses and losses related to the business. So in our previous class, in our previous discussion, we used cost and expenses when we asked to compute for the income tax due or for the taxable income, since we do not yet discuss the rules for itemized deduction. Since we reach this particular topic, so we will no longer use the word cost and expenses because that is not allowed by law, because cost and expenses represents operating expenses in accounting, and itemized deduction is also a expenses and losses, but it is subject to limitations provided by the law, and that limitation will be specifically and respectively discussed in this topic. Okay, any amount. So let's repeat the definition. These are expenses and losses related to the business of the taxpayer, whether it is a manufacturing, trading, or service-oriented business, subject to limitations provided by the tax law, and any amount paid or payable which is otherwise deductible from or taken into account in computing gross income, or for which depreciation or amortization is made, will be allowed as a deduction only if it is shown that the tax required to be deducted and withheld therefrom had been paid to the Bureau of Internal Revenue. That is a provision by law. And anyway, I'm going to discuss that later, since it was already mentioned on the requisites for deductibility. So I will discuss it in detail when we reach the requisites for deductibility for itemized deduction. Okay, so again, when we talk about itemized deduction, its counterpart in accounting is this one: selling and operating expenses and general and administrative expenses. Ugaling lang, itemized deduction is subject to limitations provided by the tax law. Kag amo ning i-discuss naton on the succeeding slides. Examples of itemized deduction. So expenses in general. So all expenses we have learned from our accounting 1 up to accounting 4 are allowed to be deducted in our tax in our gross income. Okay? So we have your expenses in general, examples. Then we have your charitable and other contributions. We have your taxes, interest, losses, bad debts, depreciation, depletion, and research and development costs. Okay, so we all know what is charitable and other contributions. So these are contributions made by the taxpayer, whether it is an individual taxpayer or a corporate taxpayer, to a charitable and other contributions. So the detailed rules will be discussed on a separate presentation or separate slide specifically made for charitable and other contributions. Same with taxes and all other expenses enumerated in this slide. Okay? And we have your pension trust. So items not deductible from gross income. So what are the items that it is not allowed to be deducted from our gross income? So any amount paid out for new buildings or for permanent improvements or betterments made to increase the value of any property or estate. So it or quote, we have your capital expenditure. Guys, in our accounting and finance, we have learned that there are two kinds of expenditures. One is capital expenditures and the other one is revenue expenditures. What is allowed by the tax code, what is allowed by the tax law to be deducted from the gross income is only the revenue expenditures. So what is or what are the difference between capital expenditures and revenue expenditures? So capital expenditures, guys, will benefit two or more periods. Take note, capital expenditures will benefit the company. It will provide an economic benefit that will flow to the company for two or more years. While revenue expenditures, it will provide an economic inflow to the company for just 1 year. Okay? So, take note, or in short, if we're going to translate what is meant by letter A in accounting terms, letter A means that it is a property, plant, and equipment. So, any amount that was considered as an acquisition of property, plant, and equipment, buildings, land, machineries, etc., the amount should not be deducted from our gross income. Also, our accounting standards will agree on this one because assets should not be deducted from our income. What is deducted from our income is the depreciation. Okay? So take note. That's why the law specifically provides that this item should not be deducted from gross income because in the first place, depreciation is allowed. It will give an unfavorable result to the state or to the nation because you are allowed by law to deduct the same amount twice because you have to the you if letter A will be allowed by law to be deducted from our gross income, then pati ang depreciation i-allow man, so there is already double deduction. So double deduction will result to a lesser taxable income. Lesser taxable income will result to a lesser income tax due. So that is unfavorable to the government. That's why it is specifically provided by law that this amount should not be deductible from gross income. Another, we have your any amount expended in restoring property or any making good the exhaustion thereof for which an allowance is or has been made, also capital expenditures. Okay, so it is still a capitalizable capitalizable expenditures relating to the property, plant, and equipment. So still the reasoning is the same with letter A. Okay, take note that an allowance has been made. When we talk about allowance, that is a depreciation or maybe allowance for impairment. That's why this letter A and B should not be deducted from gross income since it will result into a double deduction and that is unfavorable to the government. Letter C, premiums paid on any life insurance policy covering the life of an officer or employee or any person financially interested in any trade or business carried on by the taxpayer, whether it is an individual or corporation, when the taxpayer is directly or indirectly the beneficiary of such policy. So in our recently concluded topic, gross income, we already know that premium paid or proceeds received from life insurance policies are excluded from gross income. Then obviously, premiums paid on that policy should not be deducted because in the first place, the proceeds is excluded from the computation of income taxation. Obviously, the premiums, monthly premiums, annual or semi-annual premiums, whatever, it will not be allowed as a deduction from gross income because in the first place, the proceeds is excluded from gross income. So the law excludes proceeds from life insurance as part of the gross income of an individual taxpayer. Okay, next. In items not deductible from gross income, I believe it is the last item. We have your losses from sales or exchange of property. We have your interest expense, bad debts, if there are a condition for these uh, three items of three items not deductible from gross income. For losses and for interest and bad debts, what are the condition? Between members of a family. For purpose of this paragraph, the family of an individual will include only brothers and sisters, whether by whole or by half blood, his or her spouse, ancestors, and lineal descendants. Okay? So if there are transactions between members of the family, whether sale transaction of property, that is number one. Sale transaction of property, of course, uh, in order to evade taxes, you have to declare or you have to create uh, a false loss or expenses. So that's why it is provided by our law that transactions between family members should not be considered as a valid losses from sales or an interest as the case may be or bad debts or receivable. Like for example, I am the taxpayer, then my brother nag I have lent some money sa akong brother, then obviously I will declare it as doubtful expense. So my brother, quote unquote, cannot pay his account. Take note, we and my brother are family our family. So take note, we can create those scenarios because makontrol lang namon ang situation. Miski wala sang accounts receivable, miski wala sa account ang sakon, ang deklarar lang ko sang accounts receivable kung yung deklarar ko nga bad debts na siya. So ang bad debts pwede mo ma-deduct. Bad debts in general is considered as a business expenses. So try to imagine that I can create any or I can declare any bad debt expense as long as may brother lang ko nga itudlo. If that's if it's not allowed or if it is not disallowed by our law. So that is the rationale why there is requirements just like this one. To avoid evasion by overstating this kind of expenses. Losses from sale or exchange of property, we have your interest expense, and bad debts. Okay? Second, between a grantor and a fiduciary we trust. So, they are related. The grantor, kag ang fiduciary or ang the one who manages the trust. Then third, between a fiduciary we trust and a fiduciary of another trust, if the same person is the grantor with respect to each trust. So this, when we talk about fiduciary, it's like ano lang, administrator of that particular trust. So ang real owner is the grantor. So they are related. Fourth, between a fiduciary we trust and a beneficiary of such trust. Of course. Number four, between corporations of an individual and an individual, more than 50% in value of the outstanding stock of which corporation is owned directly or indirectly by or for such individual except in case of distribution in liquidation of a corporation. So take note guys that 50% is a controlling interest in a corporation. So if the transaction between the corporation and the stockholders, whether it is a corporation or an individual, owning 50% in value of the outstanding stock, it means that the decision was influenced by that particular stockholder, whether he is an individual or a corporate stockholder. So he or she or the corporation can influence the transaction between sales of property between corporation and himself, and he can authorize loans with an interest between the corporation in his self, as well as create a receivable or create a uncollectible receivable and declare it as a bad debt expense. So, pwede yan ma-influence. 1, 2, 3, 4, and 5. The root word for this is they can influence the transaction and over-declare these particular expenses and evade eventually tax payment by overstating these expenses and will result to an understatement in income tax due. Okay? So that's the reason the law specifically identifies this item as non-deductible from gross income. Requisites for deductibility. Okay, so these are the general requisites, whether what kind of expenses you are dealing with, this rule or these requisites applies to all expenses in general. By whatever account, title, the taxpayer may give to a business expenses in the books of accounts or whatever account title kanina niya, whatever name of the expenses it is, still they that particular expenses should comply with the requisites for deductibility. So the expense must satisfy the following conditions in order to be deductible from gross income. So it should be satisfied all of these requisites before it can be deducted or before it can allowed to be deducted from the gross income. First is it must be an ordinary and necessary to the business. So guys, like for example, if your business is food, you are in the food industry, so the expenses that you are allowed to be deducted is more or less the same expenses man nga gina-incur or nga gaka-incur sang iba niya mga taxpayers under the same industry. Under, in my example, under or within the food industry. Okay, that is what we meant when we say ordinary and necessary. Letter B, it must be paid or incurred during the year. So if it's cash basis, it should be paid within the taxable year nga kung diin ka nag-compute sa iyong mga income tax. Like for example, if you are computing for 2021, your expenses should be paid on 2021 if you are following the cash-based accounting method. If you are not following the cash-based accounting method, incurred. The term is incurred during the taxable year 2021. Letter C, it must be supported by vouchers and or receipts. So, other term for letter C, it must be substantiated. So letter C, it must be supported by vouchers or others or receipts. Or letter C, we can simplify that one. It should be substantiated. Okay, letter C, it should be substantiated. So all expenses, guys, it should be documented with a valid and allowed na mga business documents. So it should be vouchers, and obviously, when you are paying your expenses, you are expected to obtain official receipts from your payer, from your payee, okay? From the supplier, from your contractors, on which your expenses was was availed. Kundi mo yung bakalangin mga expenses, like for example, if that is power or utility in an electric company. So you have to secure billings from Seneco. Then after paying, Seneco will give you official receipt, and that official receipt should be together with the billing statement of the electric company should be attached to the disbursement voucher of your company. And that is what we meant when we say substantiated or duly supported with vouchers and receipts. That's letter C. Okay? Letter C na condition. Another condition, letter D. If a withholding tax is required, such tax must have been withheld and paid to the Bureau of Internal Revenue. So guys, in my example earlier, for electric consumption, if the law requires you to withhold, like for example, if your electric bill is 100,000, so you have to pay 100,000 to the electric cooperative. But the law requires you to withhold the tax from your payment to the electric cooperative. Like for example, the figure is not accurate. This is just for the sake of illustration. So, like for example, the rate or the percentage requires by law to be withheld is 2%. So, if your billing to the electric cooperative is 100,000, multiply it by 2%, so you should withheld 2,000 pesos. And instead of paying 100,000 peso, you have to pay only 98,000 because 2,000 will be withheld, and you as the taxpayer, as the payer, you are the one to to withheld the 2,000 and paid to the Bureau of Internal Revenue. That's the requirement for letter D. If you are required or if you are compelled by the law to withhold and you did not withhold the electric expenses or power, light, and utilities expense, whatever account title you may called, cannot be deducted or are not allowed to be deducted from your gross income since you did not withhold taxes which was required by the law for you to to deduct your electric expenses. So that's the four requisites for deductibility. All of it should be complied before that particular expenses can be deducted from the taxpayer's gross income. Okay? So let's continue our discussion next meeting, we will discuss the specific rules, the specific uh, rules for deductibility for contributions, for contributions, for and other expenses that the law provides a special treatment or special rules in order for its deductibility. So we will continue our discussion next video. So thank you for listening. Enjoy the rest of the day. God bless.